everyone, my name is Emily and welcome to another one of our videos. Today we'll have a look at currency carry trade. A currency carry trade is one of the most famous trading strategies in forex trading. A currency carry trade is when you buy a currency with a high interest currency against a low interest currency. Carry trading involves holding a forex trade when one currency has a higher interest rate than the other currency in the pair. The most famous carry trades involve buying currency pairs like the Australian dollar against the Japanese yen and the New Zealand dollar against the Japanese yen, because these pairs have interest rate spreads that are very high. A trader can make a profit between the difference in the interest rates of two currencies as long as the exchange rate between the currencies does not change. Many professional traders use these currency carry trades because the gains can be very big when they use leverage. However, the bigger the potential gain, the higher the risk. The currency that is exchanged in a currency carry trade transaction is known as the funding currency. A funding currency usually has a low interest rate. Traders borrow the funding currency and take short positions in the asset currency, which has a higher interest rate. The best time to get into a carry trade is when central banks are raising or considering raising interest rates. Also, these trades work well during times of low volatility since traders are willing to take on more risk. As long as the value of the currency doesn't fall, even if it doesn't move much or at all, traders will still be able to get a return. However, a period of interest rate reduction does not provide great gains in carry trades. When rates are falling, demand for currency also tends to fall and selling off the currency becomes difficult. Basically, the carry trade can result in a profit if there is no movement or an increase in interest rates. Hope you found this video useful and interesting. Thank you so much for watching us. Bye-bye.
Okay, let's go ahead and get started. So welcome to this week's webinar. Today we're going to be talking about the last part of our Fibonacci series, which will be on projections. So as per usual, before we get started, a risk warning. So our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. A disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay. I'm Melanie. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. And I will be your speaker for today. So here's today's agenda. We'll do a brief recap on a Fibonacci retracement, the ideal market structure, and then we're going to look at the different Fibonacci retracement levels, and then we'll dive into this week's topic, which is on Fibonacci projections, and then we'll look at how we combine what we learned from the previous weeks and what we're going to be learning today on Fibonacci projections. Okay. And if we have time at the end, we'll also be looking at some charts. So if you have any requests, feel free to pop them into the chat. Also, if you have any questions throughout the webinar, feel free to let me know as well. Okay, let's get started. So here's a simple checklist to follow when first starting out with Fibonacci retracements and some things that you can look out for. So firstly is the market structure curve. So you want to be looking for big zigzags, and we'll show you examples in the coming slides. Next, we're looking at how we can identify the recent trend. So are prices going down or up? And our typical advice is to always follow the general trend. Next, identify a recent major swing low and recent major swing high. So we'll show you examples, but basically you want to look for the most significant swings when you are deciding which charts to use. Next, you want to connect the two extreme points, the highest to lowest, if you are looking at a downtrend, and the lowest to highest if you're looking at an uptrend, like you see here in this image. Okay, so let's first look at an incorrect example. So here's an example of an insignificant swing, which are typically bad points to use for Fibonacci starting and ending points. Price movements here are too small and there are no significant swing highs or swing lows. So you can see we're drawing out the shape, and this is the kind of shape that you want to avoid. Here's another incorrect example. You can see there isn't really any clear shape, even though you can see that the general trend is downwards, but there's no clear swing highs or lows. Price movement is also pretty small. Okay. Okay, now let's look at some correct examples or things that you should be looking out for. So here's an example of significant swings. You can see that there is a clear move up and down with obvious peaks and troughs, and also there are clear market movements. Okay, here's another example. So I've drawn out the peaks and troughs to point out exactly how clear your market structure should look like. Okay. Okay, next point, we want to make sure that you are following the market structure. Okay, here is an example of how not to draw your Fibonacci retracement trend line. So your Fibonacci trend line must follow price structure clearly. In this case, you can see that there is a zigzag market structure. The retracement drawn here cuts through the market structure, making it less effective. So when drawing your trend line, you want to follow price movement and not deviate from it too much. Okay. So something like this, you want to pick market structures with clear upward or downward movement and something that follows price movement. This works better on higher time frames, as there tends to be less noise. So higher time frames could be one 1 hour to 1 hour, 4 hours, 1 day, 1 week as well. Okay, so here's an example again of a clear market structure. So Fib tracements can be used in both choppy and trending markets, but it is important to look for clear market structures. Okay, so if you look here, there's a lot of upward and downward movements. So that's what we mean by choppy and trending markets. But the main point is to make sure that your market structure is clear. So here's an example of an unclear market structure. So once again, it is choppy with a significant drop here, significant highs here, but you can see there isn't really a clear market structure. Okay. Okay. Now, these are the Fibonacci numbers that we typically use. So if you've been here for our previous Fibonacci webinars, this will look familiar. But basically, this shows you how you draw your Fibonacci retracement trend line and also the different types of levels ranging from the negatives to levels that are greater than 100. So the tool that's used is a Fibonacci retracement tool, but it can lead you to 3 types of Fibonacci techniques. So previously we talked about the expansions, which are the negatives, the mid-range, so 23.6 to 78.6, those are called the retracements, and those greater than 100% are the extensions. So we went through these in our previous webinars, but if you'd like me to briefly go through them again, feel free to let me know in the chat. Okay, so here you can see all the different Fib numbers that we mentioned in the previous slide and how it looks like on a chart. So just to recap again, mid-range is retracements, negatives are the expansions, and 100% are or greater than 100% are the extensions. And in all of these scenarios, we are only using one tool, which is the Fibonacci retracement. Yeah, I think it is recording. I think they might publish this webinar on YouTube as well. So you can go ahead and check it out. But if it's not on YouTube by I think the end of next week, you can email IronFX and they'll help you out there. Okay, so let's move on to this week's topic, which is the Fibonacci projection tool. Yeah, you can find me on LinkedIn. I'll pop it into the chat in a little bit. Oh yes, I also wanted to share with you guys this website. So if you're new, when it comes to Fibonacci's, okay, you can go on to the forexarmy.com and it shares exactly how to draw Fibonacci retracements, and watch a bunch of videos, extensions, and it shows you an in-depth instructions on what to look out for. So you can see that we recently talked about the unclear market structure, and now this shows you an unclear market structure from an M15 view can actually look clear on an H1 view as well. Yeah. So This area here that we've highlighted is the market structure that was on the M15 view. And yeah, so just because it looks unclear on one time frame doesn't mean that it's not usable. So yeah, you can feel free to pop this um to check this out after our webinar. Okay. Yeah, so let's get back to our slides. Yes, so we're talking about Fibonacci projections. So for Fibonacci projection, this uses 3 points. We have a starting point, a middle point, and ending point. So yeah, it's not to be confused with what we talked about previously, which was the Fibonacci retracement, which only uses 2 points. So here we used namely the 61.8, 78.6, and 100% levels. And you want to make sure that you look out for this flash or lightning bolt shape that you see in the GIF here. Okay, let's look at a couple of examples of this. So here's a simple example. You can see clearly the starting, middle, and ending points follow the swing highs and lows of the price structure. So I don't know if you can see the lightning bolt shape, but following the arrows, the green arrows, and then you extend the tail out from the last point towards the ending. So basically where it ends, we're projecting a rebound off of that level. So over here, you can see the rebound occurs at the 100% Fibonacci projection level. Here's another example with a very obvious zigzag shape again. So yeah, we've drawn out what exactly you should look out for. So you want to take note of the Fibonacci trend line following the market structure closely again, and we're projecting the price to reach this 78.6% Fibonacci extension, so that we can see it rebound off of this level. Okay, so let's see how this plays out. And yeah, so you can see that price bounces off this level just as we expected. Okay, maybe I'll just pop the link for the Forex Army website in the chat first. Okay, and yeah. Okay, so here's another example. So we want to take note of this zigzag shape once again. This time we see it inverted. Okay, but it's still the same concept. So the starting point would be here, middle point, and ending point. And we're projecting where prices will bounce off of in the future. In this case, if you have the 78.6, 61.8 levels shown here, you can see that price has already broken out of these levels, and that's the reason why we're projecting it towards 100%. Okay, so let's see how this plays out again. Okay, so you can see price reversed off of the 100% level nicely. Okay, so you can also draw invalid Fibonacci levels. In this case, we're talking about invalid Fibonacci retracement levels, and because this tends to be more common than a Fibonacci projection level. But one of the most common scenarios of this is when price makes a lower low. Assuming you are drawing a Fibonacci retracement from the top to the bottom, then yeah, it will make sense for you to make for price to make a lower low. I'll show you an example in the next slide. But if there are bars on the right that break your ending point, it becomes invalid. There are Fibonacci retracements that are negative. Previously we talked about Fibonacci expansions that are minus 27 and minus 61.8. So even though those break below the 0% level, those are still considered valid. And I'll touch on those in a little bit. But this is the example of an invalid retracement. So price has already broken below the 0%, right? And that you see over here with the arrow. So price breaks our ending point on the right, and hence we cannot use this ending point as our retracement. So you want to always remember to pick the lowest point with nothing on the right of the ending point. Okay, now let's look at how we can combine all of the retracements and the projections that we've learned so far. Okay, I'll give you guys an example of um buying. So if it's the other way around, so if your starting point was here, ending point here, then it would be an invalid retracement if price breaks above that 0%. So basically, as long as it doesn't break below this 0%, then you're good to go. But we'll look more into this when we look at the charts. Okay, so let's talk a bit about Fibonacci confluence. So Fibonacci confluence is basically when you combine multiple Fibonacci retracement levels together so that you can increase the probability of your Fibonacci levels working versus a single Fibonacci level working. So it's basically combining all of your Fibonacci retracements, but also with your projection that we just learned. So in this example here, we have three different Fibonacci methods here. So firstly, we have the minus 27% Fibonacci expansion, which is indicated by the red arrow. That lines up with the 161.8 Fibonacci extension, indicated by the gray arrow. So for extensions, we look for a Nike tick. So this would be the shorter part of the tick, and the tail of the tick would be this black arrow here. And then we have a 78.6% Fibonacci projection. So you can see all of these levels line up closely, giving you a confluence area. So most of the time for confluence areas, we're looking for an area, like a small area, not so much a specific level. So it's okay if your levels deviate from each other by a little bit. Okay, so you can see price bounced off the Fibonacci confluence area over here. Okay, in this example, we have two Fibonacci methods. We have the Fibonacci extension, which is the Nike tick method. And this is the 127.2% Fibonacci extension level, and it's in line with the 61.8 Fibonacci projection level. Okay, take note of the flash shape again. And for the Nike tick, can see that it's an inverted V shape, but it's only valid once the tail exceeds past this 100% level here. Okay, and then we can see price bouncing off of this confluence area here. Similarly, here we have the same two Fibonacci methods, extension and projection. Here the 127.2% Fibonacci extension. So the Nike tick would be starting point here, ending point here, and then the tail is here. And that is in line with a 100% Fibonacci projection. So your starting point would be here, middle here, and ending point here. And you can kind of see the lightning bolt shape as well. Okay, so that all lines up in this area here to give you a reversal because of the strong resistance level. Okay, next, in this example, we use a 61.8% Fibonacci retracement that's in line with a 100% Fibonacci projection to give us a strong confluence area over here, where price has bounced off of. Okay, I think by now you kind of get the idea. It's basically just finding a bunch of levels that line up to form a stronger resistance or support level. So in this example, the minus 27.2% Fibonacci expansion, which is in blue, lines up with the 127.2% Fibonacci extension, which is in purple. This is also the inverted Nike tick. So the head would be here, or rather the shorter part of the tick is here, and then the tail is here. That all lines up with a 100% Fibonacci projection to give a strong confluence area below here. Okay, so for Fibonacci expansions, if you were here for our previous webinars on expansions, you will know that for expansions, we're looking for a flash shape or zigzag or lightning bolt shape. So that's really similar to what we look for when we want to use a Fibonacci projection that we're talking about today. So typically, you would be able to use the Fibonacci expansion and the projection together. And how that would look like would be something like this, just without the purple arrow. So for an expansion, you would take the starting point and the ending point to be the first line of your lightning bolt shape. And then your projection would be the V shape that follows that same shape. Okay, I hope I'm making sense, but you can kind of just see it over here on the chart. Okay. Okay, so in this example, we have a swing low support over here and one long-term 100% Fibonacci projection that is in line with another short-term 61.8 Fibonacci projection. So that makes a strong confluence area over here where price bounced off at 81.084. Okay, so you can see price bounced off after this 61.8% Fibonacci projection line up with another Fibonacci projection. Okay, so following our Fibonacci techniques, trade management is also super important. So what we typically recommend is to place your stop loss beyond your key confluence area and your take profit before it. So for stop loss, the reason to place your stop loss beyond it is because more often than not, price is attracted to such strong areas of Fibonacci confluence. So if your stop loss is right before instead of beyond that confluence area, you'll most likely get stopped out before the market reverses. So that's also one of the reasons why people wonder why they got stopped out right when the market starts to reverse and then complain about stop hunting. So for take profit, we recommend to place your take profit before a key Fibonacci confluence area because there is a high chance that it won't be able to go beyond that level. So instead of reaching your profit target, it reverses back to your entry or even worse, your stop loss. And that's why people complain that the market is being manipulated because they might miss their take profit by 1 or 2 pips. So you can see in the example I've included over here exactly how you should place it if you are going in for a buy entry. So the opposite, if you're going for a sell entry, it will just be the opposite. Okay, now let me pull up my charts and then we can take a look at some live analysis. Okay, feel free to let me know in the chat if you guys have any requests for any charts that you'd like me to go through. Okay, let's go ahead and maybe we'll start off by looking at gold first. Okay, so let's start off by looking at the higher time frames first so that we get an idea of what the general trend is. So on the weekly time frame, we can see price moving upwards. Okay, so we start off by looking for any trend lines or trend channels. I don't think we have a trend channel here. Okay, actually we do. So what makes a valid trend channel is if there are two touches, at least two touches at the top and at the bottom of the channel. Okay, so we have an upward trend here. If we look at our daily time frame now, okay, you can also see that um it's moving in an uptrend as well, also in an ascending trend channel. Okay, so let's add some support and resistance levels here. Okay, so here would be my first support and my first resistance here. So I typically will try and look to see if I can pull it back as far as possible so that we can see how significant that level is. Because the more times price has tested that level, the more likely it is to reverse off of it again. Okay, so this would be my second support. And then my second resistance would just be at this week high. Okay, let's look at our 4-hour time frame. So on our 4-hour time frame, we can see that price recently broke out of this ascending trend line, or descending trend line, sorry. Okay, so that gives us a bullish signal, especially because our daily and weekly time frames all gave us bullish signals as well. Okay, this was my first resistance, and then my second resistance is here. Um, I will place my first support here because we have two swing lows. You can see price testing it a lot, but it's cutting too many candlesticks here. So it's not a good support level to use. Okay, I'm gonna place a intermediate level here. And my first support would be here. Okay. So now we can go in with our Fibonacci levels. Starting off, I can see that we have a Nike tick shape here. Okay. So I'm gonna use Fibonacci retracement. So for retracements, we use the 100% levels. So 127.2, 161.8. And you can see that price is currently testing that 127.2 in line with the first resistance, and the 161.8 is also in line with our second resistance. Okay, and for our projection, you can see this lightning bolt shape. So I'm gonna use this trend-based fib extension. That's what they call it on TradingView, but I think if you're using MT4, they call it something else, but it's the same shape, the same symbol. Okay. And we use 61.8, 78.6, and 100%. Okay, so this 78.6 lines up nicely with my intermediate resistance, and 100% also lines up with my first resistance. So I'm just going to keep those two. Then earlier I mentioned that typically if you can find a lightning bolt shape for your projection, you can use it for expansion as well. So for your expansions, we're looking at the negative numbers. So you can see that they line up nicely as well. Okay. Okay, I'm gonna look for a retracement from here to here. For retracement, we look at the mid-range levels. Okay, so we can see the 61.8 lines up with, lines up with the intermediate level, and the 78.6 lines up with my first resistance. So I'm just gonna keep those two levels. Okay. So we can see we have three levels lining up over here. Actually, we have four levels lining up here. Okay, at our first resistance. So that area is likely to attract price. And it also goes back pretty far. So that's why when we're looking for levels, we want to push it back as far as we can without cutting too many candlesticks. Okay. Yeah, so we're seeing price testing our intermediate level now because it does have two levels lining up with it. So it is a confluence area, but it's not as strong as the first resistance. So we'll likely see it break above this level and head towards our first resistance. So now let's support this analysis by using some indicators. So I like to use Ichimoku and MACD because at one glance you can see exactly what the signals are. So price is moving above the Ichimoku cloud, so it's giving us a bullish signal. MACD is also giving us a bullish signal, so it also supports our analysis. And let's look at RSI and stochastic. Okay, RSI is also moving in an ascending trend line. Okay, but stochastic isn't telling us much. Now let's look at Bollinger Bands. Okay, you can see price pushing above the upper band. So it is also giving us a bullish signal here. Okay. I think there was a question about if it is an uptrend. If you'd like the recording, I think it will be better if you email IronFX, and they will probably send it over to you after this webinar. Because I don't have access to the recordings. Yep, so there was a question, if you're buying, will you trace from lowest price movement bottom to top? So if you're looking at a retracement, you would look like you would probably do something like that. And then retracement would be the mid-range. So we're looking at these levels. So yeah, bottom to top. So your 0% would still be at the top and 100% below. Okay. Do you guys have any requests for any charts you'd like me to go through? I think we have time for one more chart. Okay. Let's go ahead and look at let's look at DXY. Actually, let's look at AUD. Okay, so on our weekly time frame again, you can see prices dropping. Okay, we see prices moving in this descending trend line. Okay, on a daily time frame, mm, on the daily time frame, there isn't really any trend channels or trend lines, but it is, I wouldn't say it's a downtrend either. It's kind of ranging. Okay, so let's just go ahead and add some levels. So this is my first support. Then my first resistance will be here. And then I just placed my second support somewhere here. And then of course at this swing high, that would be my second resistance. Okay, now let's look at our 4-hour time frame. Prices are also really kind of ranging as well. In fact, let's see if, okay, no, there's no trend channel. Okay, so we have a support level here, and let's see if I can pull it further back. Okay, no. So this is my first support, and you can see that it's an overlap support, which basically means that there are swing highs and swing lows that line up with that level. Okay, and then my first resistance would be here. Okay, this would be my second resistance, and my second support would just be here. Okay, I think you can see price moving within this channel here. I think we would continue to see price kind of testing this area. Um, but let's just do some analysis anyway. Okay, so starting off, I'm gonna look for a retracement. So I can see that price lines up, or rather this first resistance lines up with the 23.6. Yeah, I think the 38.2 as well. See. Um, okay, we don't have any projections. I think that's all the levels that we have. Oh, okay. So if we zoom out, we also have this retracement here. Okay, so um my 61.8 lines up with my first support, 78.6 lines up with my second support, and yeah, so even though this 38.2 lines up with the second resistance, we can't use it because price has already broken out of that level. Same goes for this 50%. So we can only keep our 61 and 78. Okay. Okay, and my 61 also lines up with my second support. Okay, now let's look at our indicators. So price is moving below the Ichimoku cloud, so it's giving us a bearish signal. MACD is also giving us a bearish signal. Okay, so you might want to go for a sell from where price is at now to our first support. Since there is quite a bit of resistance at this level here. Okay, because we have two swing lows here, and can see price testing that same level with the 61.8 as well. Let's look at RSI. Okay, not much. Let's look at moving average as well. So moving average, what I like to look for when using that is looking for any of these crossovers. So crossover basically means that there is a change in trend. So over here, we could see price moving upwards. The minute we see price cross over, that's a signal that the trend is going to change. And then we saw price drop after that. So we could be seeing price continue to drop as well, or until it crosses over again. Okay. So yeah. Okay. Let me know if you guys have any questions. If it's all good, I think someone requested for my LinkedIn, so I'll pop that into the chat now. And yeah, if there's no questions, that's all the time we have for today. I hope you guys found it helpful, and I will see you guys next week. Thanks, everyone. Bye. Bye.